In V1, somebody could avoid redemptions by hiring the loan to value, because if somebody came and wanted to redeem, the positions were sorted based on the loan to value ratio, and you started from the bottom. In V2, that changes, and I think that's a fascinating mechanics. If a redemption comes in, troves or loan positions are sorted by interest rate, and the one that pays the least will get redeemed first. So the one that had kind of not the free launch, but the best launch, also gets punished first. So you as a user, how do you set the rate? We expect that we'll have a market rate in average. So if you want to be on the safe side, you put a higher rate because then you're redeemed later. If you are maybe a big market maker and you want to be really aggressive and take out a cheap loan, you lower your rate.
Welcome to the Edge Podcast. I'm DeFi Dad here with Nomadic from 4RC. Today's show spotlights Liquity V2. In this episode, we get a preview of how Liquity V2 builds upon the foundation of Liquity V1, introducing a more capital-efficient borrowing design with several innovations, including user-set interest rates, support for LSTs in addition to ETH as collateral, and a new sustainable real yield mechanism. But before we do, just a quick word from our sponsors who make the Edge Podcast possible. Introducing REDSTONE, the fastest growing oracle for DeFi. REDSTONE is the leading oracle for liquid staking and restaking assets, supporting over 60 chains with both the push and pull models. REDSTONE protects more than $3 billion of total value locked and is trusted by more than 100 clients, including the biggest protocols in DeFi, such as Pendle, Venus, EtherFi, and Athena. The unique modular design of REDSTONE makes their price feeds available cross-chain, including EVM, non-EVM, roll-up networks, and all types of app chains. REDSTONE aims to bring the industry forward by supporting upcoming Bitcoin staking tokens and continues to be the #1 oracle provider for liquid staking and restaking tokens. Soon the team will unveil the highly anticipated REDSTONE token to decentralize the protocol. Learn why Nomadic and I rely on REDSTONE for our favorite DeFi apps at redstone.finance and join the REDSTONE expedition today. Discover MERLIN Chain, the cutting-edge Bitcoin Layer 2 trusted with over $2 billion in total value locked. MERLIN revolutionizes Bitcoin by unlocking its true potential with native L1 assets, lightning-fast transactions, and ultra-low fees on an EVM-compatible network. Elevate your Bitcoin experience with MERLIN Chain today at merlinchain.io. Power up your portfolio by borrowing, lending, and multiplying your favorite assets, made safe and easy by the industry-leading automation tools at SUMMER.FI. SUMMER.FI offers a curated DeFi experience to access the highest quality protocols and strategies. Discover new earn strategies for your portfolio in a user-friendly app designed to filter based on the tokens you hold, the networks you transact on, the protocols you trust, and the highest available yields. Learn more today at SUMMER.FI, the best place to borrow and earn in DeFi. Tired of hopping between tabs, searching for new tokens before the hype catches on? Try MATCHA.XYZ, the DEX aggregator from 0x. Matcha connects hundreds of DEXs so you can trade millions of tokens and find fresh new drops. Matcha works out the best route to save you money on every trade. Swaps are free and Matcha has everything you need to trade on-chain. Gasless swaps, limit orders, and cross-chain, all in one place. Search Trade Done at matcha.xyz. Catch the tide of the mainnet launch of Puffer Finance. Whether you're an Ethereum staker or an aspiring node operator, Puffer delivers the decentralization revolution with its cutting-edge technology. Start with just 2 ETH to unlock the potential of native liquid restaking and maximize your earnings. Join the movement now and anchor your stake at puffer.fi. All right, let's introduce Michael, the CEO of Liquity AG, and Max, the head of growth. Michael and Max, welcome to the Edge Podcast. How are you doing?
Great, and thanks for having us again. Really a pleasure and looking forward to it.
Today, we're going to talk all about Liquity V2. Nomadic and I are power users, I guess, of Liquity V1, and we've gotten to enjoy all of the benefits of that as a, call it a CDP protocol. For those of us in DeFi over the last few years, we've seen shortcomings, I guess, in, the design of certain protocols. And when it comes to the lending and borrowing space, we're just really excited for how Liquity V2 is looking to fill in the gaps or make improvements upon the legacy design of V1 and other lending and borrowing protocols. So we're going to talk about user set rates today. We're going to talk about the bootstrapping of this Liquity V2 and how the protocol is going to incentivize liquidity coming into Liquity. So that said, why don't we kick off with just more about the design behind Liquity V2, maybe a little bit of background on Liquity V1 for folks that aren't as familiar. There's clearly a lot that's gone into this new design. So Michael, maybe you can kick us off with that.
Sure. Happy to dive into Liquity V2. And I think our goal here is really to set the gold standard for CDP and stablecoin solutions. And we'll dive into why we think the innovations really can make that happen. And as you said, Liquity V2 is also a CDP stablecoin system like Liquity V1. And just quickly to touch on Liquity V1, has been running for 3 years, has issued more than 4.6 billion in loans, one of the most forked protocols out there, DeFi protocols. And since the last 3 years, it has been running flawlessly, I would say. So V2 builds on top of V1, kind of, and inherits a lot of the good stuff and design choices. And the things that changed, one was a big user need that we are addressing, that people said, can we have also other collaterals, LSTs, which are yield-bearing? So V2 is multi-collateral. And the other thing which we touched on, where V1 didn't perform that well, was in high interest rate environment. That had different reasons, but especially because then people were selling the stablecoin to get more yield with another stablecoin. That triggered redemptions, and people couldn't get the capital efficiency they wanted. So V2 addresses that with user set rates, kind of the great innovation that ensures that V2 is working under all market conditions. And maybe the third, I think, important innovation is then the stablecoin, which is called Bold, should have similar properties like LUSD being unstoppable, one of the most decentralized stablecoin out there. And the big difference to V1 is in V2, it gets real yield. It gets the most of the interest that borrowers pay go to the stablecoin, which I think is also a very interesting property. I think that's in short, I would say, to give users that know V1 a bit a heads up. I don't know, Max, do you have anything to add?
I would just add that we've also revisited the redemption mechanism for Bold versus LUSD. Long story short, both are leverage machines, right? You go there to borrow, but the V1 had redemptions processed against positions based on their loan to value. So Liquity V1 offered some of the highest loan to value ratios in DeFi for ETH, but you probably would get redeemed against if you tried to get that close. And so with the V2, we now do it on a different parameter, user interest rates. And so we're excited to see, how Bold can act as a better leverage machine as a result.
Guys, we'll get into kind of each layer of all this a little bit later on, but I want to call out, we did a podcast on Liquity V2 almost a year ago. And then I believe part of that plan was scrapped. Looks like you went back to the drawing board. I'm just curious what you saw in the market, or what made you kind of say, hey, no, we need to kind of reiterate this thing. It's not ready. It's not fully cooked. Like, what was the thinking behind that?
Yeah, the last time we spoke, we were looking into a reserve-backed design, and that can have some limitations or under certain market conditions, and it's a more complex product. And at that time, we had these higher interest rates, and V1 started to suffer because of that. So that was a main trigger that we said, how can we address that? And also just kind of being eager. Nobody really innovated on the V1 model. And so we were in a retreat going through the reserve-backed design, and then we started just brainstorming. How could we make that better? What's the core problem here? And then we came up with the user-set rates, which we thought, hey, that's really interesting, because in V1, it's a one-off fee. You don't have an interest rate, but this causes problem. And we really thought that aligns very much with kind of the values, and that would make the protocol one of the most market-driven solutions. And nobody touched on it. So these two things, seeing kind of V1 suffering and saying, what would we innovate if we touched or forked ourselves? And that started the design process in November 23. So I'm really glad to see all the progress we made. So kind of V2 is coded. It's right now in audit. And we plan that in Q4, probably in November, we want to launch it. And I think that was just a pleasure to work with that team that has so much experience to be able to, from the first idea until delivery within 12 months. I think if we achieve that, that would be a great achievement.
Guys, in terms of Liquity V1, one of the benefits that, we were always excited to spotlight, to tell other users and friends about is the fact that it was uncensorable. So can you just remind us, before we move on and talk more about Liquity V2, I mean, V1 will continue to be operational, right? It lives on. And my assumption is that at some point we'll see all folks migrating over to a V2. But anyways, how does that play out in your mind? Am I framing that up correctly?
Yeah, sure. I mean, as I said, V1 is battle tested. It's here to stay. Especially for people that love this battle testedness, only want ETH as a collateral, kind of this die-hard solution. And especially if rates are going down again, Liquity V1 is still a very good solution again. So I think we will see both in parallel. V2 performing better in all markets conditions, maybe addressing a broader audience. But yes, as you said, V1 is here to stay.
Guys, maybe let's talk a bit about Bold. So anybody coming to the table and kind of looking at V2 will notice you're introducing a new stablecoin called Bold in addition to V1's LUSD. Maybe just give us the high level touch points on it. How will users acquire it? And then Max, maybe you can take the second part of this question. I know we were talking about in Telegram, there's kind of a different risk premium versus, I think you said monetary premium balance you're trying to play out with this. Maybe just kind of give us the TLDR on Bold.
Yeah, so how is Bold created? I mean, how does the system work? In principle is that users want to take out a loan. They bring in their collateral. In V1, it was only ETH. In V2, we will accept Lido and Rocket Pool. We wanted to go just with the two most battle-tested LSTs out there, because V2 will also be immutable. So you deposit your collateral and then you mint your loan in Bold. As a stablecoin, it will have very similar properties like LUSD. It's just backed with two more collaterals. That adds a little bit of risk. Otherwise, you still have the great properties of LUSDs, because what a lot of people do or miss a bit is LUSD and Bold will be one of the very few stable coins, or Bold in explicit, that give real yield and is directly redeemable. So where users have a direct claim to the underlying collateral, and that's one point why I said the gold standard. That's one part of the gold standard. Our fiat currency, we're on a gold standard. You always had the claim to the underlying collateral. So I think that's the gold standard for a stablecoin, being able to have this direct claim to what you believe in as a crypto user to the underlying very liquid collateral. So you always have the exit route in the most liquid collateral out there, Ether, and the other two are also very liquid. So I think that's a big differentiator for the stablecoin, and why it's interesting to hold.
Yeah, and to Michael's point, right? A lot of DeFi native stablecoins that are coming to the market today really focus on the yields you can earn through them, whether the highness or the volume of those yields or where those yields come from. And that's appetizing. It's attractive to users. But the reality is, if you're paying out a lot for a stablecoin, it's because the market demands that, right? That it's there's a perceived risk somewhere, somehow. And where I think the Bold model will really shine is that with the slight adjustments we've made to, what LUSD brought to the market, we think we have an asset here that is going to be like a premier savings and earning vehicle within DeFi, because it has a native rate that can be earned. LUSD didn't have that, but it also still retains the redeemability, right? Which is something not a lot of projects can claim to have. And it does impact, the market's kind of risk appetite for a given CDP stablecoin, if that's the case.
And just to add one more thing, so how you could think about it, maybe even less as a stablecoin, but I think what we aim to introduce here is like DeFi treasuries with Bold. Because why do people like treasuries? Because there is not much counterparty risk, and because you get a decent yield. So with Bold, if you put in a stability pool, you don't have this counterparty. You have still the direct redeemability, and you get this native DeFi yield, which isn't tied to any centralized player or RWAs. So you have kind of this base asset and product that gives you kind of the same profile you have with treasuries in the CeFi world. And that's interesting, first of all, for users, because I think there are many products that have these properties. And the other thing is then the interesting part, what can be built on something like that? Because I think that's a bit a missing piece right now. And that's also the market or kind of the niche we target.
Guys, in going over the white paper, this new white paper before this conversation, there's a lot of, I think, novel and new things that you're bringing to the table that are worth calling out and going through in a bit more detail. But I want to kind of walk through it more as like a user would, if that makes sense. So maybe we can just start at the top. Like the first thing a user might be thinking when they're coming to Liquity V2 is like, okay, what collateral can I bring to the protocol? So I know you've introduced new collateral types. Where does this user start with collateral? What can they use?
They can use, like in V1, ETH, and we added 2 LSTs from Lido, so wrapped staked ETH and rocket pooled ETH. So it's really focused on ETH believers, kind of an ETH-centric product. There aren't any other collaterals.
Guys, any thoughts on when LRTs would be battle-tested enough? I can understand the decision here to like move forward with just those LSTs first, but yeah, what else do you think needs to be seen in the market before we can add LRTs as collateral?
I can maybe touch on why we didn't add it. I think Liquidity, because it's immutable and you get this predictability of the protocol, we are very cautious and we only take in what's really battle tested because you can't change it. So Liquidity is always like a step behind. Of course, a lot of people ask us for LRTs and other stuff, but I think we need to be cautious there. On timing, I don't know, Max, you have a take on that when you're thinking LRTs already?
I mean, my personal view is that the slashing risk associated with LRTs is obviously very, very different than the one with LSTs. And if we're deploying something that's immutable, I don't think LRTs would ever make sense in the context of how Liquidity Core, right, deploys this type of protocol.
So another new thing that I've seen here is this idea of user set rates. It appears that a user can come and set their own interest rates. Can one of you maybe walk us through the how and the why of that?
Sure. So that's a major difference. In V1, you had the one-off fee. And now in V2, if you go then to the front end, you choose your collateral, you say how much you want to deposit, you take out the loan, and there is a new parameter. You can set your rate. So from 0.5% to 1,000%. And you can adjust it anytime. That's important. So for the first time, you as a user, you become a rate maker instead of a rate taker. And of course, there's a caveat. It sounds too good to be true because everybody would set it to 0.5%. And Max already hinted to it. Why did we introduce that? With the interest rate, you not only control the cost of the loan, which is nice. By the way, in DeFi, that makes it predictable. You just know what you're going to pay unless you changed it. So it's not some governance in the background that is changing it overnight or within 48 hours. It's not a very volatile rate based on utilization, which you've seen it. It's really a new mechanic. So, but going back, what does the interest rate also controls? And Max already said it. In V1, you had the thing called redemptions. And we already said that's a nice feature of the stablecoin, because a redemption allows every user, not only the borrower, to go to the protocol and say, I have 1 BOLD, give me 1 BOLD worth of ETH. And users usually do that if the stablecoin is below peg. So this gives also a strong peg guarantee to the BOLD. So if the stablecoin is 99 cents, somebody could come and say, I want $1 of ETH. That's a redemption, and that gives the nice property. But this also means for the borrower that usually they don't want to get redeemed. They don't have a loss, but they lose. What happens on their side is they lose the exposure or some of the collateral. Somebody pays back their loan and gets the collateral. They're net neutral, but they lose the exposure. In V1, somebody could avoid redemptions by hiring the loan to value, because if somebody came and wanted to redeem, the positions were sorted based on the loan-to-value ratio, and you started from the bottom. In V2, that changes, and I think that's a fascinating mechanics. If a redemption comes in, troves or loan positions are sorted by interest rate, and the one that pays the least will get redeemed first. So the one that had kind of not the free launch, but the kind of the best launch, also gets punished first. So you as a user, how do you set the rate? We expect that we'll have a market rate in average. So if you want to be on the safe side, you put a higher rate, because then you're redeemed later. If you are maybe a big market maker and you want to be really aggressive and take out a cheap loan, you lower your rate. And then, of course, you need to, what will happen is if the stablecoin is above peg, so this ties into the peg mechanics. If it's above peg, then nobody will be redeemed. So users will lower their rates. And if they lower the rates, less people will hold the stablecoin. So less demand, then the peg is falling. If it's kind of below $1, then users are afraid of getting redeemed and they increase the rate. And now you have more yield on the stablecoin, so more people hold it. So this is the new dynamic, which is very market-driven. That's the market-driven point. It's just by people setting the rate on the borrowing side and people on the holding side holding the stablecoin. And it's like a carrot and stick. Borrowers can give some yield, and that's nice. People hold the stablecoin because it's nice yields. But if it's that there is too little yield, then stablecoin holders will say, hey, we don't like the stablecoin, we dump it, and we're going to redeem you. So kind of these two forces in a very direct way work together. And this brings everything back kind of to the important role which user set rates have. It's really to bring borrowers and holders of the stablecoin. It's like a borrowing lending market, in essence, in an equilibrium. That's what we introduced, and that's what users can manage and then also steer themselves. So that's the big difference. And on the UI, you set it at the beginning, and you can adjust it at any time.
Boy, that finally got through for me. That was a really well said, articulate way of framing it up. So V1, we all enjoyed the same, low interest rate or no interest rate, I guess technically. And the problem that we ran into with V1 over the past year, and correct me if I'm misframing this, but it seems that LUSD had fallen below peg, so we were in redemptions, and as you mentioned, you're ranking those loans by LTV or loan to value ratio, and so at the end of the day, of course, that can be a really terrible user experience to to be at risk of being redeemed, because this protocol has always appealed to folks that want to be long ETH or are using it for leverage with ETH. And obviously, too, when you're living through like a downtrend or like a bear market, things can really start to get ugly. Fast forward to V2 now, instead of being worried about being redeemed because LUSD is below peg and your LTV is really high, you actually can pay to be prioritized and not being redeeming, and then you can have ultimately a higher interest rate, which makes a lot of sense. It also like calls into effect like the idea that I would imagine that Liquity could really turn into a revenue machine. Like it just sounds like a great opportunity to allow users to get what they want, which is leverage, even at like a high LTV, risking a lot, but being able to avoid that redemption if Bold were to go below peg. Anyways, am I getting all of that? Like it actually, I guess, wait, there's one more follow-up here is if I'm in V2 borrowing and I've got an interest rate that's been set lower, and let's say that the system is looking like it might go into redemptions, or just the fact that like Bold has been like waffling below peg, and I'm worried about getting ahead of that. I had a lower interest rate. Can I adjust that interest rate to pay higher in advance to, basically ensure that I won't be redeemed if, we start to go through redemptions?
Yes, you can adjust it at any time. So you can set it higher. The only thing, every time you adjust it, you pay a 7-day worth of interest. That's just kind of to prevent some attacks. So every time you do that, you shouldn't do that hourly. But other than that, I think 7 days is a good frame. You can adjust it. And to make that even easier, because now you need to manage the rate, we have a feature called delegation. So a user can delegate the rate setting. First, you can delegate it to your hot wallet if you don't want to take your cold wallet setup and just manage it much more easily. You can delegate it to a third party that is doing that in a better way, or even we call it batch delegation, to really a service provider or an entity that manages that for you, also takes a fee and then is able to batch update all the interest rate based on a custom strategy together, which makes it also cheaper to adjust that. So we hope that we there see some providers coming up and helping people to automate that process.
Hey everyone, before we get back to the show, excited to tell you about a new omni-chain Bitcoin solution called FBTC, which has already surpassed $125 million in TVL and become the fastest growing BTCFi asset this summer. The FBTC Points Campaign Sparkle offers sustainable yields plus points and token airdrops from strategic partners such as Babylon, Mantle's new token Cook, and more. To learn more, visit fbtc.com/ongoing-campaign. And special thanks to FBTC for sponsoring us at the Edge Podcast. Do you foresee any strategies for folks that are using the system? Like, before we talk about the real yield that's being generated, so that this is really important that we cover, how folks are going to be generating yield, because I think this is a big part of what will attract, liquidity and ultimately yield to V2. But yeah, for folks that are using V2, like I'll call out, like if I was thinking like short term, I might be looking to set my user interest rate really low because I'm going to be executing some like strategy to earn yield elsewhere. So I'm borrowing on V2 for a really low rate, and then I'm earning something substantially higher than the borrowing interest I'm paying on V2. However, then there's folks like who maybe are just getting into like a long-term position that, this could be a year or longer, and they're wanting to set a rate that is safer, that's going to keep them from getting redeemed. So anyways, any other strategies you and the team have thought through or you want to call out for users that will want to get started with V2 once it's live?
I think how you can think about it, what we expect or what we think could happen is that in V2 you get the market rate. No, because it's set by the market and set by the user. So maybe at the beginning it's at the DSR rate. So what you will expect is just kind of what do I need to pay in DeFi, like the market rate. Will it rather go up? Will it go down? Well, you could think of the maker rate that is set by governance and spiky, kind of like smoothed out. So it should reflect that. So I think that's how you should think about it. V2 just enables kind of these two sides to negotiate the fair price of borrowing and then holding the stable coin, which is in a sense lending. So I think that's how you can think about it, that with V2 you get a more predictable forward-looking rate. So I think it makes sense to think about what do I need to pay now, and this is rather going up and down, and then monitor the market and then adjust it accordingly. And you can then also look at how much debt is in front of you, so how secure do you want to be, how much extra yield are you going to pay. I think these are all considerations that then come into play.
Really interesting. I am very excited for some of the automation that, I imagine will be built with this. You're willing to, again, go in at, let's say, a lower interest rate, but you need that automatically adjusted. Being able to do that and pay someone a fee to do it, it just makes a lot of sense. It's crazy how, I have to say, V2 looked so complicated to me at first glance, but once you framed it up as it's ranking these loans based on the interest rate, and hence we are rewarding or prioritizing those who are willing to pay a higher rate to open up a loan. I mean, it just makes so much more sense. You took a variable that was essentially fixed, that was constant for all users in V1, and now that's ultimately going to generate revenue for the protocol. So actually that leads us into real yield. One thing I was trying to understand, just reading through your docs, is so V2 introduces a sustainable yield mechanism. I guess what can you tell us about that? How does the protocol generate and distribute value to those that participate in it? Or, let's talk about liquidity holders themselves.
Yes. So where does the revenue come from? From the borrowers that are now paying an interest. So that's the revenue source. And what does the protocol do with the revenue source? And I think that's the second part of the gold standard, because nobody else is doing that. And actually we do, the protocol does a very natural thing. It takes the borrower revenues and gives it to the holder. And it will be a split. So 75% will go to the stability pool depositors, which hold bold and put it there to ensure liquidations. And 25% have a more flexible mechanism, which we built so it can flow to LP pools, to liquidity, where also people hold bold. So I think, again, that's why I said it makes it the gold standard. It passes 100% through kind of to the holders on the other side. So you have a very market-driven system, just connecting people that want a loan and the people that can give a loan, and they can negotiate the price. They want to do that with the interest rate in between. And I think, it blew my mind that nobody has done that before. And maybe I could pull up then afterwards a slide. But just if you think about it, what is a CDP system about? Balance of borrow and demand on the one side, and then really funneling these revenues through. And if you look at the existing solutions, you have solutions like Maker, which is funneling with the DSR, kind of the borrower interest to the other side. But Go and Curve, for example, in the current state, the interest doesn't go to the stablecoin holders directly. It's just kind of indirect. It has to find its way. So that's why I think it's very market-driven V2, because it just flows where it should go. And so that's one dimension. And the other dimension is how the rate is set. Because the CDP system is how revenue flows and how the rates are set. So revenue flow, we see there are direct solutions and indirect. And rate setting, there are indirect, like governance, so Go and Maker. And there are more direct ones, algorithmic, like Curve and V2, where it's the users. And if you span up these metrics, V2 will be the only one that has direct revenue flows and where rates are directly set and not governed. So that's like a new market, a new niche that we are opening up with this solution. And I think that's really exciting. And going back, so that's what I said. When you think about it, that's how a market-driven system should work. But interestingly, nobody has explored it in that way. And I think we are really excited to see how this will work.
So earlier, I think you alluded to the impact that this market-driven rate could have on DeFi. Can we just go back to that really quickly? Like, dumb that down. Like, what are you foreseeing? Like, we're going to have a rate here that is the result of users being able to set their own rates. It really should ultimately lead more folks to the protocol, and that's going to have the impacts on utilization of other protocols out there. And anyways, how do you see this playing out?
Yeah, I think why it can be interesting because V2 could become this immutable DeFi building block. Others can build on top of it because it's predictable, because there you find the rate that people currently need to pay in the market. And that's because of this peg dynamics. It adjusts really quickly because it has strong incentives and sticks. So that's one important part why we think you find there the market rate. And as I said, the other part is then like, being able to have these DeFi treasuries and use that to build new products on top. Use it for perps, use it for interest rate swaps or yield product. I think there we see the biggest utility or also growth potential for a V2, that it can be used for that, for DeFi native products that can be built on top of that. And that's just a building block that isn't there right now because rates are set with governance or you don't have these DeFi treasury qualities of yield sources.
Guys, you mentioned Liquity V2 becoming this building block. I recall I was just looking at DeFi Llama the other day for this, and I think V1 was forked around 37 times. It's in the top 10 of forked DeFi protocols of all time. And it looks like you've addressed how this is going to happen going forward with V2. So maybe just break this down, your strategy behind forking, and ideally like how you retain some value in these events when people say they really like the code and they're just going to use it. And then also, I'm also curious, just like what sort of protective licenses do you have in place? Like, okay, how are these things implemented or enforced? That makes sense.
Yeah. So, as you mentioned, right, Liquity V1 is one of the top forked protocols of all time. And when we look back at that track record, right, I would say it's quite unclear how that accrued value back to LUSD or helped LUSD expand. And so as we were building out the V2 and coming to the conclusion, we think we've built the perfect CDP template, basically. There's going to be a lot of demand for this beyond just ETH-based collateral. And we foresaw an opportunity to leverage that. I guess is the simplest way of putting it. And so with all that said, right, with our V2, we've put it behind a business license that it goes on for a couple of years before reverting to an open source license. We're not the first to do this. Most of the big DeFi projects have done it already. Our view on this is that the source code is available, right? Any user, whether they're retail or institutional, can look at how this thing works, get that level of clarity, and make the decision on whether or not they want to use it. For us, DeFi is more of a user-based definition. Obviously, this space is founded upon open source principles, but at the end of the day, liquidity, is a very relevant factor when we talk about DeFi. It's not just the code. And so for us, if we have users who are able to keep custody of all their assets, complete transparency of the system at all times, that's what matters. And so we were comfortable making that call on the V2 code base. And over the past few months, we've reached out, I would say basically to every EVM ecosystem under the sun that could make use of this for their native assets, for their, assets that people want to borrow against, and just other, more edge cases than just, the native gas token or what have you. And we've had a really great response, whether it's from existing DeFi builders who want to, take a stab at a stablecoin, existing stablecoin teams that are looking at, leveling up their current offering. Everyone's been very eager to work with us. And I think that says a lot about Liquidity's reputation to begin with. And so we spent the summer signing basically letters of intent. Now that the code base is live and being audited, we're now, making those binding license agreements. And we're looking forward to coming to market not only with our core deployment, but a whole, wave of forks in the ensuing months thereafter. And yeah, so we'll see if it works, right? Obviously, most other DeFi protocols have taken the singular brand and expand approach. For us, we don't really see a future in which this code base, propagates 25 times, is beloved on every single chain, and we don't, benefit from that. I think, winning mindshare goes a long way for a stablecoin that's meant to be a safe and secure earning vehicle, right? It makes people comfortable at all levels across the food chain, so to speak. And that's how we see the strategy panning out in the long term is beneficial to us, even though we're not, the ones deploying on 20 different chains or whatever it may be.
Max, I might have missed this, but maybe you already addressed it. So with this kind of it's almost like a white label solution that other people can use, but is Bold still the underlying stablecoin? Will it still be proliferating Bold, or will people kind of be generating their totally net new stablecoin and just kind of using this protocol design? Does that make sense?
Yeah. So these are all net new, right? This is our way of expanding the code base without diluting the Bold and Liquidity core brand, right? By introducing collateral types our power users may not be comfortable with. So each fork, separate stable, separate governance token. And, any material differences between deployments, right? Some teams have a different ethos than us, right? Some may want to do RWAs. Some may want a degree of mutability, all those types of, changes that are possible. We're not, chaperoning or stewarding anyone on this. We'll make sure that they disclose what's different versus ours. Users can make that decision, but we're all separate entities.
Awesome. And you mentioned governance token there. So a new term that I saw kind of in your white paper, this protocol incentivized liquidity. I've heard of protocol owned liquidity, but maybe break down what is PIL, and then how does this kind of impact or involve the already released Liquidity token as well?
Yeah, so in the V2, right, as Michael was alluding to, 100% of protocol revenues go back to the ecosystem, let's call it. The lion's share of that goes to stability pools, but in our deployment, at least 25% of all protocol revenue will be distributed by LQTY stakers. So the way the UX on this works is you have your LQTY, you've staked for a period of time, you have a voting power boost if you can stake longer, no locking or anything like that. And yeah, every week you have a pool of Bold, right, that the protocol generated as revenue, and that can be distributed to any target on chain. So liquidity pools for Bold, lending markets for Bold, market makers that you think are doing a good job, you can just send it to their address if you so please. Anything's fair game. It's a very agnostic module. So people who have used Curve in the past, are familiar with like gauge weighting, right? It's a similar system here. It's just in our case, there are no more LQTY emissions. It's purely protocol revenue that's being distributed that way. And this is a module that's open to our forks as well. Presumably, they'll use it for their governance token emissions, in addition to whatever protocol revenue they give back. But it's our way of basically ensuring that at a protocol level, there are no funds piling up anywhere. There's no treasury to go after. But also that if you are a bold holder, you can expect there to be a kind of interplay between the protocol and the secondary liquidity it exists in, right? Again, like none of this stuff is in a vacuum. And so it's kind of our way of having a system that is market aware, without, sacrificing immutability or involving our core team efforts as much, in provisioning that liquidity.
And just to add on that, I think what's important, that's really just 25% of revenues that LQTY staker can influence. All the rest, the core protocol, the core parameters, the core functionality is not touched. It's the same as in V1. And why did we do that? We wanted to keep it immutable, yet adaptable, especially on the liquidity source. And then I think that's also an innovation. Liquidity is a key challenge for every stablecoin. So how do the others solve it? Somehow in governance, somewhere hidden. So we wanted to find a way and to ensure on a protocol level that it's taken care of and people have more confidence that liquidity will be there and that somewhere we have a sustainable source of rewards that can be driven to these sources. So that's why it's protocol incentivized. It's ongoing incentives that can be funneled to liquidity or other means, the 25% of the interest, and it's not protocol-owned liquidity. But I think that's also very interesting innovation we haven't seen. So, that makes me really excited. All these things we can try out. And I think if we want to build decentralized solutions that are ideally immutable, kind of with the core ethos of DeFi, I think these are very interesting steps where we should try new approaches. And that's what we will do with V2.
At Moonbeam, we're building a world where the wonders of decentralized technology are accessible to everyone. We're advancing Web3 integration through product enhancements, funding for innovation, and investment in our partner ecosystem. Our product roadmap includes ZK initiatives, tokenomics updates, and 8x throughput. Our $10 million innovation fund invests in startups that deliver cutting-edge solutions for RWAs and Web3 gaming, and our partner ecosystem continues to grow through grants and incentives. Moonbeams is delivering frictionless user and builder experiences to create the future of the internet on-chain. Join us by participating in the Moonrise campaign today.
Yeah, and I think this is kind of taking us in a step where V2 looks like a much more governance-lite protocol by design. And I think you're both kind of keying in on some of these things, these points. There's a lot more automation and protocol level actions that are happening rather than maybe, what we've kind of somewhat gotten used to in some senses with this big DAO that's, not really that efficient. So yeah, maybe just kind of speak to that a little bit. One of you, just this intentional kind of stripped down governance that maybe some people might be a bit unfamiliar with DeFi.
I mean, I would say we're in a unique position, right? With LQTY being fully distributed and the core team not having had a DAO all these years. And so I think what we've seen from other stablecoin issuers in the space and other DeFi projects in general is that there's a happy medium somewhere, right? Like there are certain things where a community of a protocol can coordinate over, and it's just a matter of finding the line. Where does it make sense to have this level of engagement? And I think what's cool about ours, right, is that we don't have to decide what this looks like, right? It could very well be the case that the majority of LQTY stakers want bold USDC on Uniswap and call it a day, right? No need for forum posts, no need for any horse trading or whatever. But, there can always be the case that there are interested entities that want to provide a lot of liquidity for Bold and get paid for doing so. And maybe they want to put their word out to community and people can decide on whether that makes sense or not in their view. So we'll see which way this all goes. And, for every fork, it'll look different too, presumably. But what mattered for us, right, is that we saw the immutability at the core, and that, these outcomes were hard-coded, right? We're not deploying this with like 10 liquidity pools set and, have fun. It's all very agnostic. Yeah.
Max, before we close out, I'd love to hear your thinking as head of growth on how will Liquity V2 attract users? Like, there's a lot of competition in DeFi right now. So, like, how are you, thinking to attract, borrowers and onboard new users to Liquity V2?
Yeah, I mean, there's a few levels to it, but I think in short, we as Liquity do benefit from quite a good reputation. So we are expecting our power users from V1 and LST to give us a shot when we launch later this quarter. Ultimately, right, we are kind of at the mercy of where the market's at. In the short run, people will mint Bold to go chase yield opportunities elsewhere, right? Carry trades. And so if the market is in the mood for leverage, whether it's for, looped yield exposure or just going for an asset like ETH's price performance, right? Like that'll play a role for sure. We're very keen on, collaborating with our forks in the post-launch period as well. Most of our license agreements do, revolve around a little bit of collaboration on things like liquidity. So we think that'll be an opportunity for growth, let's say in the medium term as well, as those forks roll out and we have our initiatives with them. And then, lastly, I would say from a long-term perspective, it's very much a demand side question, right? Like, do people feel comfortable holding in Bold? Do they think it's, something they don't mind getting dumped on by the people using our system for leverage, right? And that's, how secondary liquidity works for CDPs. I personally think with our redemption mechanism and with the native yield we offer, right, it won't take a lot to convince people that it's okay and safe to hold. So there's a few moving parts for sure, and we're not in control of all of it, but we do think, the cream will rise to the top on this. And we think also that we have the right kind of both community and alliances forming as well.
Great stuff. And I do want to just call out that I know, like, having recently reviewed V2 as best I could, and then obviously getting this deep dive here, like, I am so excited for V2. I really did see users get burned by the redemptions by LTV there, during a short time frame. But, prior to that, I really felt like Liquity V1 had stood the test of time, and, seeing how those redemptions played out, it clearly called for some action. And I think you guys as a team have gone back to the drawing board and figured out a really clever way to build on a lot of what we love about V1, but fixing the one thing that was, ultimately a shortcoming, I think, in terms of the redemption mechanism. So this user set interest rate, just could not be more excited to be able to use that. And so on that note, we should close out. I want to make sure you get to answer the most important question of when is V2 expected to go live. But before we do that, just a quick reminder to our listeners, they should learn more about Liquity by going to liquity.org. They should follow Liquity Protocol on Twitter or X. They should follow Michael and Max's handles. Michael's is Svoboda Michael, so just last name then first name, and that's in our show notes. And then Max, it's his last name _Max. So check that out in the show notes. Make sure you follow them. They've got lots of interesting insights to share on Twitter. And then, guys, thank you for coming on. It is a privilege when we have a team like yours that's willing to, have a conversation like this. Liquity V2 is definitely a protocol that I'm looking to use as like a long-time DeFi user, someone who's looking for leverage on ETH, someone that's looking to access stable coins that are reliable and censorship resistant. So that all said, when can we expect V2 to go live?
Yes, so we finished coding, more or less. So the code is public. You can look into that. We are now doing the audit. If everything goes well and we haven't overlooked anything major, we hope to go live in November. So that's the plan. As you know, there can be unforeseen things, and if we need to go back to the drawing board, we will do that, but then we'll have some delays. But I think there is a lot out there to prepare. As we said, code is out there, really great README that Rick did. I haven't seen such a detailed, thorough README for a long time. Testnet is live, so soon we'll also make the UI live. So there is a lot people can already learn and look into to shorten the time until launch.
And one more reminder for listeners, just check the show notes on this, whether you're listening to the podcast or watching the video. And we'll try our best to add some of the helpful resources that, are there for folks that want to prepare for that V2 launch.
It's such a pleasure to talk about these things with you. So thanks a lot.
Thanks everyone for tuning in. If you're a talented founder or developer, please consider reaching out to our team at fourthrevolution.capital. And for future episodes of the Edge podcast, please check out our link tree at edge_pod.